At SFE Partners, we specialize in driving growth for mid-market B2B businesses through tailored sales and marketing solutions. By aligning people, processes, and technology, we help businesses scale, optimize performance, and achieve measurable results. On this episode of Billable Banter, SFE partner Pete Paglia sits down with Rudy Minar, partner at Mirus Capital Advisors, to explore the evolving dynamics of buy-side and sell-side diligence in today's M&A landscape.
Hello, welcome everyone. Welcome to the latest edition of Billable Banter, where we explore insights, trends, and strategies for middle market and founder-led businesses, as well as for private equity and venture investors alike. I'm Pete Paglia, your host today, and I'm also one of the partners here at SFE. Today's topic is very timely with what's going on in the market. Lots of businesses are contemplating due diligence and transactions. There are a lot of opinions that are going on in the market right now, and we wanted today to really explore best practices, both through the lens of the buyer and of the seller in a successful due diligence process. We're fortunate to have Rudy Minar join us today to help us talk through this conversation. Rudy is a partner at Mirus Capital. Welcome, Rudy. Appreciate your being here.
Thanks, Pete. I'm excited to be here, and I'm looking forward to the conversation.
Rudy and I have, just by way of introduction, Rudy and I have known each other for years, done a few transactions together. As an operator on the sell side, I've really become to trust and value the perspectives and the detail and the systematic processes that Rudy uses during a transaction process. So I thought it would be great for him, before we get started, to give a little bit of background on himself in the work he's doing at Mirus.
Thanks, Pete. Yeah, so I've been an investment banker for over 25 years, and Mirus Capital Advisors is actually 35 years in the business. We're a company that has been working with founders and family-owned businesses during that time. And our focus is really helping those founder-owned businesses realize the value of their accomplishments. And what we really focus on, and the value add that we bring as an investment banker, is helping founders and shareholders get premium outcomes for their business. And a lot of that is based on what we're talking about today: understanding the diligence process, and understanding how the company presents itself to potential buyers can generate good outcomes. Excellent. I particularly work, and I just mentioned also that I particularly work in the technology space, which is very much focused on growth and emerging and new technologies and efficiencies. But a lot of what we do is across the board: industrial, manufacturing, food and beverage. So the same precepts and techniques around preparing for diligence apply to all those kinds of businesses.
Absolutely. Rudy, first question, the elephant in the room with what's going on with government policies right now, and the impact they're having and the uncertainty they're having across markets. Can you, from your perspective, share your views on how that's impacting the state of M&A in general?
Yeah, I'd say in general, investors and buyers don't like volatility, and there's been a lot of volatility in the markets. So there's been a pause on mergers and acquisitions, or a slowing, I would say. So I just closed the deal yesterday, and that had started and signed an LOI in January. So things Congrats. Are moving forward, but things deals are facing more scrutiny internally from the buyers. And I think also sellers are thinking about, well, if the markets are so volatile and valuations are fluctuating, maybe it makes sense for me to wait a little bit before I go to market. And so I do think that actually this is a good time for sellers who are thinking about potentially having some sort of exit over the next this year, to take some time and help take this time to prepare for a transaction. So it's actually nice to have a little pause to do that, and hopefully they could get some good ideas around how to well prepare from this podcast.
Are there specific industries, as you think about the impact to M&A, that are either more impacted or potentially more immune to some of the uncertainty?
Yeah, so I think, again, the immediate impacts have been around companies that are facing either supply chains that are impacted by the tariffs that are coming up, which also seem to be changing. And it's pretty broad, and the secondary and tertiary effects of those tariffs are still working through the system, because a lot of companies may have electronic components that are going to be subject to Chinese semiconductor tariffs, and software companies or metal companies. But again, I'd say that it's pretty broad. Even in the defense industry, there's been large volatility, and some of the services companies are impacted because of the government efficiency initiatives. So I'd say it's a pretty wide ranging there, but and there are some winners. Again, some of the software companies, I think, that are providing tracking and ways to manage costs. It's going to be helped by the fact that there's, companies need to focus on cost efficiencies. So that's probably an area that might be positive.
Excellent. We see the same, right? We do a fair amount of service business on the diligence side, and we're seeing some of the same, at least anecdotal feedback that you've shared. As you think about some of the scrutiny and the preparation that you said now is a good time to begin to think about, can you be more specific or elaborate on some of the areas where you do think that diligence preparation is most important?
Yeah, so it's funny because as we talk to buyers all the time, and I was just had some conversations last night, and many of them are taking a look at trying to figure out how to maintain the revenues and growth around their businesses. So they're looking at a lot of different ways to either implement technologies or honestly change out the management teams or realign their go-to-market strategy to upgrade to better performing professionals or better ways to measure their performance. So I think, and they're applying those same disciplines when they're acquiring companies. They're looking at the commercial diligence process as being core to their buy decision and their valuation decision. So the commercial diligence, I think, is probably the most important thing that both buyers are considering, and sellers need to be able to present in a very crisp, clear way to potential buyers, so that and that is a very broad set of disciplines, whether it be understanding competitive positioning, being able to articulate the ideal customer profile and the customer base, retention of those customers, how the sales force and organization is aligned, what those processes are, what the go-to-market partners are, what the supply chain looks like to be able to fulfill those orders. And again, number one priority, I think, in almost all of these processes are, again, from both sides, is having a measurable sales funnel and pipeline with KPIs so that you can provide an investor or a buyer a good idea of what the predicted and forecast revenues are going to look like. And for the business, again, it's a way for them to understand what targets they need to hit and how they can achieve growth objectives.
You and I have worked on a couple of deals where you were extremely focused on ensuring a very highly qualified pipeline. And as a seller, I certainly appreciated the efforts there, because in some cases it needed to hold up to that scrutiny, because you don't want to surprise the buyer. Certainly doesn't want to surprise that first quarter after after an exit or after a close. So I certainly appreciate the commercial scrutiny that you mentioned. Can you point to, as you think about kind of best case, an example of where a well-prepared diligence process, both on behalf of the seller and maybe even on the buy side, resulted in maybe a more successful exit than what otherwise might have been?
Yeah, I think that's a good question. I can't overemphasize how much preparation and being ready for a process can impact the outcome and the valuation. And so again, we're focused on that. Buyers are tending to, and sellers, you look at how deals are done and they're looking at comparables and metrics around profitability and gross margins and revenue growth. But those are just, arithmetic calculations. And so being able to spend time before you go to market and preparing and understanding your business before you go to market can pay off big time if you're able to spot certain trends. So we want to understand in the preparation phase what the growth drivers are, who the competitors are, what are the what is inhibiting growth, and where are examples of the company making investments maybe around a good marketing plan and a good web presence can impact value. So we had a company that we were working with that was, on the face of it, didn't seem like a very interesting company that would generate a lot of high bids. They had flat revenue for the last 3 or 4 years. Their profitability was much lower than their peers. And we looked at the business and said, we're not sure that this is a business that's going to sell for a high value. Why is this? And we spent some time, we spent about 3 months trying to understand what was going on with the business. Because when we talked to the management team, they seemed to be excited. They said, we've got a good brand name, we're selling a lot of product, but there's no indication of that in the metrics that we looked at. And what we did, though, is we did a lot of data sorting and data cutting, and we then we were better able to understand the company. And what we understood was they had a new set, they've been investing in a new product set, which had just started rolling out. That had cost millions of dollars and it had impacted their profitability. And that was why their profitability was lower than others. But they had actually developed a game-changing product, and by measuring the metrics on those products, those sales were growing at 25% year over year, which was crazy. It was way higher than, again, their peers. And so what was happening, it was the overall performance of the company was flat, but that was being masked because of their older product lines were
legacy
declining.
Products.
So again, and you know this when you see this with Salesforce, and they also then decided, well, look, these new products need a different sales organization. They're not going to sell off of our old business, which was more of a catalog business. We need to have a direct sales force. So now, again, we're investing in hiring new salespeople that are targeted at these new accounts. And so they started an account-based sales organization. And they also realized that they had to put a new marketing campaign around that. And there were a lot of things going on there. And but what happened was we were able to emphasize that in our sales process when we reached out to potential buyers and investors. And guess what? Those buyers were smart and knew what was going on. And there was also, I should mention, overall, this product realignment was based around a tectonic shift in their end market, which had gone from being largely academically focused instrumentation and more research oriented towards commercial applications around Internet of Things. That business attracted a significant amount of interest. And we ended up having a bidding war because of the way we were able to articulate those fundamental changes in the business and how well they were doing, with this new product line, even though it was not, it was still a small but growing piece of their business. It turned into a war amongst the potential buyers, where everyone suddenly wanted that business because they realized that management team had been smart, and the engineers had developed a very good product, and they were making changes in their organization to sell that product better. And again, the buyers were very excited about that because they wanted that business to help be a catalyst for their own existing businesses, because they had similar businesses that they wanted to combine it with. And it was a very, very good outcome for the sellers. We got 5 times what they expected, and the buyers were willing to pay that and said, this is what it really helped articulate to the buyers, was that this was a management team and a company that was executing really well, even though when you first looked at the metrics, it looked like it was not doing well at all.
So to summarize, you reprioritize metrics like maybe new product growth, right? To highlight where the significant growth is coming in the business, and not mask it with some of the legacy products. You built trust, and you helped them build trust in the team, and you made sure that they looked like they had an execution machine with the processes that they built.
Yeah, that's right. And again, a lot of that stuff is you need an outside party to help you do that. The management team was smart. They had an outside board that was not all executives, and they were all smart guys who were from the industry. But until they conducted that exercise and had a third party like us come in and say, and it could be someone like SFE, look, this is what's happening. How do we do this? And then being able to, I call it's glib, but we helped package that story. And that's very important. And I think you can't underemphasize the amount of just being able to present the right information in a simple, easy, straightforward way. Because I wasn't, making that strategy. The management team was, but it resonated very quickly to the buyers, who, again, they had a lot of smart MBAs and a lot of folks who had knowledge about the industry and who were operators in the industry, but they can't spend 2 hours looking at spreadsheets or 10. They want to see it right on one page.
And I'd imagine, when that doesn't happen, you are running into situations where things like valuations or earnouts come into play, and that obviously can undermine a deal potentially.
Yeah, I think one of the main things that that I think companies should be cognizant of, a lot of what is part of the diligence process is not just what the answers are, but how you answer them, and your ability to provide answers in a crisp, clear way, and which builds confidence in the fact that the organization is executing well and develops, a connection and a trust with the buyer, between the buyer and the seller. And, if you say this is what we've been doing, and we've been measuring, and we've had these processes in place around the pipeline to qualify things, and you can provide a very simple report and say, this is what it is. It may not show good results, but the fact that you're able to articulate it and say, well, this is the discipline we've had, can be helpful. So, and it can be bad, again, if you don't have that. If you're scrambling around trying to present information and you're reluctant to answer questions, it can cause the buyer to hit pause and reconsider what they thought they understood, and now think, I don't understand things. And those kind of those kind of pauses can have an impact on price and valuation. We've had occasions when, again, a company said, well, this is our projections, and then when you tell them a month before while you're in diligence and you signed a letter of intent, and you suddenly say, we're not going to hit, we think there's been some slowdown. the buyer can say, oh, well, that's going to impact valuation and we're going to have to reprice. If at the beginning of the process you said, here's our process, and we think this could be the high and this can be the low, start preparing the buyer for, hey, we think that there's a lot of friction now and whatever these potential accounts are or whatever's going on. So we're actually now reducing our projections, for this range. They can say, okay, that's good. We understand that, and they'll build that in, and you avoid that second wave of, hey, do I really need to haircut it? Oh, they told me that they're going to do X million. Now they're doing 20% less than that. Now we're going to have to reprice. And so I think thinking about this not as an adversarial thing, but as a process where you're upfront about things. And a lot of what I think advisors can help companies with is just to do that self-evaluation exercise, to be a little bit more truthful. You could, again, be positive and aggressive about potential outcomes, but you also want to be more rigid about how you are presenting the information so that you can instill that confidence and be less mysterious. Because the more mysterious you are and the more black box, then you're leaving a lot of stuff up to chance, and you may get lucky, but a lot of times buyers are smart and they'll figure out, oh, I just don't, if I don't have any visibility, then I'm going to look at the downside risk and I'm going to therefore, reprice, or I'll say, oh, we can let you we'll still go with this price, but now we're going to move a significant portion of the consideration from upfront cash to a retainer. And once you hit those metrics, you'll get that, earn out. But if you don't, because you won't. So I think sellers need to be cognizant of that.
Yep. One of the things that we do a lot is we spend time with people thinking about, from a sales perspective, the technology and the enabling processes that will help drive revenue and sustainable growth. There's so many options around the tech stack today, and then of course you overlay AI throughout the workflow on top of that. There's just a wealth of opportunities for businesses today, and sometimes it's hard for them to at least prioritize where to make that investment or what parts of the tech stack can impact positively a company from a diligence and an enterprise value perspective. Thoughts on, particularly as you've been in technology, what parts of the tech stack have you found to be most important as you think about positioning a company for an exit?
Yeah, I've been doing this for many years, and the enterprise IT technology has matured so much over the last 20 years, where there was an expectation that people would have accounting systems and then ERP systems that were linked to that. And now there's been a whole new ecosystem around the MarTech marketing technology stack. And those are, pretty much today, you have to have that technology in place. There's no way that, if you don't, it's a negative perception from the buyer side. And as a manager of a company that's selling, not having ability to access that information is going to be, again, it would trouble me as a manager not to be able to do that. And again, it's very hard to understate how important everyone now has, Salesforce or some kind of CRM system and Sales Cloud. And then now they're linked to the marketing stack, and RevOps is a whole new division of, investment around how you get revenue operations automated and be able to track KPIs and be able to manage the whole cycle of acquiring a new customer and maintaining that relationship. And again, most buyers are tracking all of these things. Whether on software, they're looking at annual recurring revenue, and they're looking at net dollar retention and gross revenue retention, and they're looking at other metrics around that, which are you need to have systems in place to track that. Trying to do it on a, without automation is impossible. So, and again, having that system in place, even though it may seem like it's a lot of money, it's table stakes now. You can't not have this information. And the better and more automation that you've been able to implement, business analytics is now again another thing that people are expecting. And or I'll give you an example. We had a small company that was roughly 35 million in revenues, but they had spent a long time, about a year, implementing a business intelligence system so they could automate and so they could shrink manufacturing from 12 weeks to 8 weeks, and they could track the costs across that, and then they could also have a good understanding of, and they wanted to tie it in with their CRM system so they could understand when orders might be coming in. And so they were optimizing their workforce, working very efficiently. They're optimizing their supply chain, and they had a very, very impressive system. And again, it was, it takes time. The COO, or an engineer who had been one of the VPs of a product, had developed that system, had the idea, spent his weekends for a year doing that. When it came time to sell the business, we were in a diligence meeting with the buyer, which was a very a top tier venture capital firm that had a growth equity fund. And the CEO of the portfolio company, who had been a public company management team, jumped out of his seat when they started presenting their pipeline and then how that worked through their manufacturing process and their delivery and their shipments of product. And he just was happy like crazy. And he was like, I haven't seen this system like this in a small company. You're running this business like $1 billion company, and you're a small $35 million business. And we knew we had the deal then. That guy he was willing to pay a big premium because of that, because he's like, wow, these guys are really on the ball.
That's amazing. That's a great story. So if you were approached by a founder today, like you say earlier, that now's a good time to prepare, and I'm thinking about what that preparation cycle looks like. You touched on some of this earlier, but maybe to summarize, what are the things I need to do as a founder to get ready? How long do you think I need to give myself to get ready? And also, through the lens of the buyer, help me understand what their priority is going to be. Because obviously you've talked a lot about, building the team, the processes, and the trust at the seller side, but there's also a set of perspectives that are a bit different on the buy side. So can you maybe contrast what a founder should be thinking about as he's preparing his company, as he's starting to look at it through the lens of a buyer?
Yeah, so I would say that again, from the as a seller and as a company owner and founder or manager, I think what you want to, the purpose of preparing for diligence and the purpose of the diligence sessions is to demonstrate a compelling story around the business, be able to help the buyer validate some of their assumptions about what's going on in the market, and understand how the business has been able to leverage its strengths, and also mitigate any risks or work around any weaknesses, because they're a small company, and most companies are, again, competing against larger public companies and much large companies with more resources. So to be able to demonstrate to that buyer what the game plan has been and how that company has been able to execute on that game plan, and made the right investments in the right technology to track it and the types of KPIs they're tracking, and be able to also address potential concerns around what the buyer is going to have as well. How do you take the company to the next level? Or how do you achieve whatever the next objectives are to enable, get better profitability, increase your gross margins, whatever it is that would be part of the plan. So being able to articulate that is a very important part of diligence, and it's really storytelling and helping connect with that buyer to that, so that they believe in what you've been able to articulate, and what you've also shown them in the financial projections. Without that commercial diligence process and that narrative around it, it's not as compelling. And from the buyers, again, buyers, I think they're looking at this as a way to validate assumptions around the business and identify risks. And the real thing, again, is even strategic buyers, generally, they have a very good idea about understanding of the financial aspects, but they don't necessarily understand all of the market dynamics or all of the industry-specific drivers. Even, again, if it's a big company, they just may not know that market segment or that market niche. And so they're trying to identify risk. So being able to anticipate where they're going to ask questions is important. And again, I think this is where an outside party kind of validating your plans and coming in and helping a business understand where the buyers might assess things and be worried about certain risks, and being able to anticipate that and articulate immediately, hey, we see there might be some problems here, this is what we will do if we need to, is very helpful, because again, it shows that for the buyer, they get confidence that, oh, this team's on the ball. They know that their weaknesses are, but they've got a plan to work against that. That's what they want to hear, because there will always be some. Nothing is perfect, right? There's always some weaknesses and there's some strengths, and being able to work around that and be honest with the buyer, or as a seller to be able to say, hey, I know I have this problem, but I'm taking care of it. I think that's a very powerful argument when you're talking to a buyer and saying, hey, look, again, the commercial diligence process is, I'll use the example of a car. I've got this beautiful Ford Mustang, and now they start looking under the hood. And if you could tell them, like, look, I've done some work on this and that. I know I need to replace the water pump. The engine's overheating every once in a while, but she still goes really fast. I've got good compression on the cylinders, and I just need to manage this. And, you could get a sale at a premium, but if you just, because they will eventually, smart buyers will eventually find that out, and you'll still get good value for that car.
Yeah, it's a nuanced point too, but your point on the strategic versus maybe a more traditional institutional buyer in some of the commercial priorities do matter. And even there, like you say, the strategic buyers may have specific synergy on market or go to market, but they still need that confidence, right? Because at the end of the day, you're going to be part of a broader strategic plan for them. And of course, institutional buyers, they're very heavily financial driven from the start. So it's a great perspective. Coming up on time, Rudy, love your thoughts here. Any final commentary on or recommendations as you're talking to either mid-market companies or even investors?
Yeah, again, I would say that I think that in general, there is as a seller, there's a reluctance and a concern around what's universally called the proctology exam of diligence and having to go through that process. And I think that's just not the right kind of attitude to have. What sellers need to think about is this is not an adversarial contest. It's really a opportunity to show off all the stuff that's made the company successful and what it is. And you wouldn't have been in business this long, or you wouldn't have achieved the goals that you've set out to if you weren't doing a lot of things the right way. And that's really, I think, the attitude that most that sellers should really think about this. Not like, oh gosh, I'm going to get audited. And again, you need to understand as a seller that this is not something where there's the right answer. It's just, here's what it is, and let me explain things that are bad or good about the business. And from the seller side, I think that's exactly what they're looking for. They've seen and they've had a couple meetings and they've looked at the numbers and they've been in a data room and they've been looking at a lot of documents and maybe had a couple meetings with the management team. But the diligence process is really about how they can validate, and they want to do a deal, and they want to understand what's the secret sauce that company's been developed that's enabled them to be so successful. So I think for them, I think it's a great thing. It's like, how does that guy win so many races? What does he do? We think we're just as fast as him, and he's winning all those races. So I think I think of it as a very positive event, and it's a way for both sides to do a lot of learning and listening and understand what makes good businesses work.
Awesome. Rudy, thank you so much. Really appreciate your time, your expertise, your insights. People want to get a hold of you. How can they do so?
So the best way is, again, we've got a website at Mirus, which is www.merger.com, Mirus Capital Advisors, and you can look me up. I'm on LinkedIn, and happy to return any emails. It's just minar@merger.com.
Excellent. Rudy, thank you again. Been very insightful. Appreciate your time today. And for all those who've listened, thank you. I hope you found this helpful, and we'll see you on a future episode.
Thank you, Pete.
Whether you need strategic guidance, operational improvements, or hands-on support, our team is here to empower your success. To learn more about our services and expertise, visit our website and connect with us at www.sfepartners.com. The information in this podcast does not constitute investment advice or an offer to sell or a solicitation to buy any security. Some of the statements within contain opinions based upon certain assumptions, and these opinions and assumptions may prove incorrect, and some statements within describe outcomes achieved by clients, which outcomes resulted from company-specific circumstances. Actual results could vary materially from those implied or expressed in such statements for any reason. The views expressed in this podcast are solely those of the host and guests and do not necessarily reflect the official policy or position of any agency or company. Mirus Capital Advisors makes no warranty or representation as to the accuracy or completeness of the content in this episode and is not responsible for any losses, damages, or liabilities that may arise from the use of this podcast.